Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Monday everybody. I hope you all had a lovely weekend. Today, Monday, Xi Jinping is set to meet US President Joe Biden on the sidelines of a Group of 20 summit. This is the first in-person meeting between the two heads of state since the pandemic began, and we will be unpacking the exchange in tomorrow's video. For today, though, we'll need to move through several important economic developments, and we need to start with the biggest of these developments, which is on the housing market front. Over the weekend, the People's Bank of China and the China Banking and Insurance Regulatory Commission issued a 16-point plan to rescue China's property sector. Combined with the 20 COVID easing measures that were also announced over the weekend, these two developments together signal to the market that China's top leadership under General Secretary Xi Jinping may be reprioritizing the economy. Quote, "It's a meaningful easing. It seems that the room for policy change has widened on various fronts after the Party Congress, including for the two major headwinds to the Chinese economy, zero COVID and property." End quote. The jointly issued notice was sent to financial institutions. Both Chinese and Western media is reporting that the plan contains measures that address the key issues in the housing crisis, like developers' liquidity issues and home buying demand. Whether the measures are enough or effective is another question, which we will examine in the coming weeks and months. Some analysts remain skeptical regarding how much Beijing can actually do now to revive its housing market, especially as other economic headwinds are hurting growth and consumption. Quote, "The extreme pessimism in markets has finally led to a key policy change on the biggest overhangs over the economy. It's still hard to say whether this is going to be a turning point for the economy, though." End quote. And quote, "Will these measures work? It's hard to say. China's property sector has been driven by a combination of out-of-control speculation, an insatiable appetite among home buyers and property developers for debt, and a banking system eager to lend against real estate. Perhaps it will be possible to reverse home buyer sentiment, but after decades in which property prices were seen as a one-way bet, the past year may have severely dented what was once an article of faith. Without that faith, the property sector can only decline further." While many policymakers still seem to think it possible to resolve China's property sector excesses at little cost, there is a real risk that if the latest package doesn't work, credibility will be further undermined. Needless to say, that won't help. End quote. But in the short term at least, the markets have reacted positively to the news. In Monday trading in Hong Kong, Chinese developer stocks and bonds surged. A Bloomberg intelligence gauge of builders' shares jumped as much as 15%, bringing this month's gain to 56% off a very low base. High-yield dollar bonds rose at least 5 cents on the dollar. Major property developer Country Garden Holdings Co. saw a stunning 52% jump in its share price in morning trading, up almost 120% in 5 business days. This suggests that the market is reading the new easing measures as part of a rescue plan for developers, a sign that Beijing, in the face of a years-long collapse in sales and decline in home prices, is flirting with abandoning its deleveraging efforts to reprioritize growth and stability. Griffin Chan at Citigroup thinks so, calling these measures a, quote, game changer, end quote, because it is, quote, the first comprehensive support policy from central authorities, unlike previous piecemeal steps, end quote. According to the new plan, developers' outstanding bank loans and trust borrowings due within the next 6 months can be extended for a year, while repayment on the bonds can also be extended or swapped through negotiations. We will likely see some developers saved to fight another day, with others left to be carved up by state-owned enterprises. Of course, if Beijing is serious about reviving its property industry, if it is even possible to do at this point, it will likely take more than these policy easing measures. China's $2.4 trillion new home market remains fragile. Property debt defaults have surged and investor and buyer confidence alike has been smashed. According to Citigroup estimates, at banks, the proportion of bad loans related to property has surged to 30%. We remember too that China's property developers will see about $290 billion of offshore and onshore borrowing coming due through the end of next year. Quote, China developers are facing another peak in debt maturity next year. If regulators don't make adjustments for property-related policies, developer liquidity will continue to deteriorate. This will very likely trigger systemic financial risk. End quote. Next up, more important economic developments. Hey guys, if you're enjoying today's video, don't forget to hit that like button. And if you like what I do here on China Update and you'd like to help me keep it sustainable, Patreon and Buy Me a Coffee links are in the description below. This is the primary support for the channel and allows me to continue making these episodes every day. As always, thank you so much everybody for the ongoing support. In an unprecedented move and a very pessimistic sign for the company specifically, but also potentially national consumption health generally, Alibaba Group Holdings Limited has decided, for now at least, to not disclose full sales results for its signature Double 11, also known as Singles Day shopping event, for the first time ever in the event's 14-year history. Singles Day, which originated in China, indeed it was invented by Alibaba CEO Daniel Zhang in 2009, has in recent years become the world's largest shopping festival. In previous years, Alibaba has been happy to publish its positive results. However, this year all the company would say was that its gross merchandise value was in line with last year's performance, quote, despite macro challenges and COVID-related impact, end quote. Last year, the company saw about $76 billion in sales. Of course, it would not be surprising if this year Alibaba and others saw disappointing results. Quote, weak buying sentiment among mainland Chinese shoppers and logistical disruptions will persist amid ongoing mobility curbs under China's COVID-0 policy. End quote. Analysts also point out that Alibaba is increasingly operating in a diverse and highly competitive environment, with rivals vying for market share. As such, poor Alibaba performance is not necessarily entirely a reflection of national consumption. We hope to have more macro data for spending across the broader set of platforms in the coming weeks. Next up, China's southern Guangdong province, which is currently wrestling with a massive COVID outbreak, more on this tomorrow, is testing a new approach to pricing debt as part of China's wider $4.7 trillion local government bond market, in the hopes of improving financing efficiency and encouraging greater pricing differentiation among provinces. Quote, the new method would allow a wider bidding range for investors. With the local government bond market matured, the necessity of referring to the central government bonds for local bond pricing has decreased significantly. End quote. The Financial Times writes that the move could increase the appeal of local government debt for foreign investors who have historically been turned off by bond pricing which doesn't reflect credit risk of the provinces. As an economic powerhouse, home to the Pearl River Delta, Guangdong's edge in this regard could help it bring down funding costs, though of course less safe and poorer provinces will suffer the opposite. Okay, that is today's episode of China Update. Thank you so much everybody for watching. I will see you all tomorrow.